Got Dipan Mehta as well joining in on the show to walk us through his outlook. Dipan, hi there. Good to have you on board. Let's begin by just getting in your thoughts on the auto space and what exactly you make of the kind of response that we've seen to the initial bookings for the Harley, the Hero Harley bike, and what exactly do you think the implications could be for an Eicher and other players? Do you think that it's critical that they sustain their performance down the line?
Good morning, and thank you for having me on your show. I'm not surprised with the response that the Harley model has got from Hero MotoCorp. I think initial new registrations or new order bookings are always strong. And no doubt, I think there is one more competitor in the market for Eicher Motors. But the market itself is expanding rapidly. And a lot of Eicher sales come from that 250cc to 350cc type of range, whereas Harley Davidson and Bajaj Triumph are beyond 350cc range. And of course, they will have some pricing strategies in place to take on a market leader. And there's no doubt that they will chip away at Eicher Motors' market share as well. But the entire segment is growing pretty fast, and Eicher still has adequate room to grow. They certainly have an edge over Hero MotoCorp and Triumph in terms of the brand, in terms of their cult following, in terms of their distribution, and they have a huge export opportunity as well. So I'm not too perturbed about emerging competition from Bajaj as well as from Hero MotoCorp. I think Eicher Motors will be able to withstand that competition and still grow at a reasonable rate. By reasonable, I mean anyway like a high, mid-teens type of growth rate on a top line basis. And that is enough to get us those compounded earnings in Eicher Motors over the next few years or so.
Dipan, while of course, strategically, and these are just reports right now, we don't have any confirmation on this. While, it's a no-brainer that this is positive news, the group wants to stick to their core competencies and their core businesses, and they don't see Adani Wilmar as an extension to that. What happens to Adani Wilmar shareholders?
See, I think it is a well-managed company with an independent board as well as dynamic top management. They have certainly grown the business pretty well, and future dynamics also are quite decent. FMCG industry is like an evergreen industry in India and continues to have secular growth momentum. The shares are also richly valued and comparable to other FMCG stocks. So if the Adani Group wants to, liquidate their holdings, I think that's just a rumor at present. Then I think it makes sense from that point of view. It helps in deleveraging the group balance sheet, which is always very well received by the investor community. And I think it will go a long way in further increasing the confidence within the group, in the sense that the biggest risk factor in an infra company is the debt on the books of the actual operating company or its parent company. And if that is reduced, it certainly increases the kind of flexibility that the group will have in terms of pursuing its present growth plans.
Bernstein has given an outperform rating on Adani Ports, saying that it's comforting to see that they managed to retain the guidance on the balance sheet strength, and that's going to be another stock after its numbers that you may see some more moves on. And they say that Adani Ports continues to be a prized asset. That's what Bernstein has to say about Adani Ports post its numbers. A couple of other stocks which are also going to be in focus. And, a couple of them buzzing from yesterday. There was a Biocon, of course, which sprung up a good 4%. And Dipan, it's quite intriguing to see that Pharma has made a comeback. And it seems that this is not just a temporary comeback, but you are seeing some good numbers as well come by and good commentary as well. Seems like the comeback is here to stay.
See, more and more we are seeing the commoditization taking place within the pharma industry. And apart from the domestic market where brands are very important and there's some amount of secularity in growth, when it comes to exports, there's a high degree of cyclicality and high degree of commoditization. And as is the case with all commodities, they will have their upswings and downswings. And this is one of the periods when the competitive intensity is less, pricing pressure has reduced. And of course, raw material costs also have come off for pharma companies. So they are seeing their entire export business. And by that, I mean US generics, Europe, Africa, Asia, across the globe outside India, where you are selling generic drugs, whether it's bulk drugs or formulations, the pricing environment has improved. And we are seeing this kind of, pickup in the performance. But whether this is sustainable, I doubt it, because end of the day, pharma companies globally are also expanding, including Indian pharma companies. They are setting up new plants. They're going in for more and more approvals for new drugs as well as existing drugs. So the competition can always come back again as well. And on the whole, I think one of the biggest issues is the kind of price to earnings multiple that investors will pay for a business which is getting more and more commoditized. So from that point of view, I think next few quarters may certainly be very good for pharma companies. But then, these are no longer that secular growth stories which we had pursued back in the 2000 or 2010 era, when companies like Sun Pharma, Lupin, Dr. Reddy's, Cipla were easily growing at 20% plus, and because of US generic market, that sort of scenario doesn't exist anymore. And it's not that these companies are really attractively valued as well. So I think as an investor, I like to remain invested because I think there's a great trading rally and there's an upswing for next 2-3 years or so. But from a fresh investment perspective, I think just wait and watch and let's see if we can get at a correction.
I want to, extend that point with you, whether you feel the valuations are justifying the growth that these companies are delivering.
See, there's nothing new. Since I've entered the market, ABB, Siemens, Cummins, Thermax have been expensive stocks and they will remain so. And there's so much of scarcity of floating stock that even small amount of buying takes these stock prices up. But by and large, I think they are in for good times. The entire Capex cycle has picked up and it is going from strength to strength. And it's a very big component of the economy. And on the whole, private sector Capex is what drives the growth at the likes of Siemens and ABB. And typically these cycles will last for 3 to 5 years or so. So I'm pretty certain that Siemens, ABB, Thermax, Cummins, all of these can easily deliver 15% type of returns over the next 3-4 years or so. But whether I want to buy them at these valuations, that's more of a mental block than anything else. You can't buy companies at 60, 70, 80 times trailing earnings per share. So I give them a pass. But these are great times for investors who have patiently waited and invested in these companies. I think they are reaping the fruits of their patience and they're getting the returns that they deserve and the conviction that they're put into these businesses.
My limited point is that order book is the lead indicator of where business cycle is moving. But margins and valuations also are lead indicator as to the quality of the earnings and the projected return. So order book is great, but that is not the only thing which I think we should get excited about.
Yeah, that's right. I think, Nikunj, also the margins are looking up because operating leverages come into play. There's more business going around. So companies can bid for that business at prices they are comfortable with. So from many points of view, I think these are great times for all these high-tech, Capex capital equipment companies. And of course, you will have to be prepared for volatility in earnings, because these are not straight line businesses. There'll be some quarters where large dispatches take place, large billing takes place, and immediately you will see the profitability and the revenues shoot up at that point of time, and there'll be lean quarters as well. But to cut the long story short, I think next 3 to 5 years are very interesting for Siemens, ABB, and other high-tech capital goods manufacturing companies. They have largely restructured their businesses. They are focused only on products and services where they have a clear-cut technology edge, and they have a lot of support from their parent company. All of these companies are exploring exports to the parent company now that Make in India, export from India has gathered so much of momentum globally as well. So there are many positive dynamics for the likes of Siemens, ABB, and such companies. It's just that, from an investor's perspective, just the valuation ratios are a bit daunting. And typically you want to buy these companies, when the chips are down, when they are struggling with getting order books going, and when the valuations are more reasonable, which is not the case just now.
Dipan Mehta, you must be very happy. Paytm, Zomato, Policy Bazaar. खुश तो बहुत हो गए.
Thank you, Nikunj, for remembering. I always, I like to think 5-10 years ahead. And when I close my eyes and see which are the companies which will be, the great growth engines of 10 years ahead, then certainly you have to look at companies like Paytm, Zomato, PB Fintech, Nykaa. I think they are businesses which are unique. They are one of a kind. They're operating in kind of blue ocean scenario. They can grow consistently for 15, 20 years also at that 15% type of growth rates. And they are great compounding machines. Now, of course, there are many challenges with their business. They can be disrupted by themselves as well. But these are entrepreneurially driven companies, and India, you make a lot of money if you bet on the right entrepreneur, as we have seen, whether it is a Reliance Industries or whether it is Asian Paints or any of or Titan for that matter, Tata Group companies. So these have all the kind of ingredients which are there for a multi-bagger. And if you remain patiently invested, at some point of time, positive news flow will drive the stock prices higher.
Dipan, I'm just going back to this whole space again. When you say that these stocks have a long way to go, so do you think next 2-3 years, Paytm could go back to its IPO level, Zomato could go back to its IPO levels? While we may talk about the rally in some of the stocks, 50 has become 100 for Zomato and 400 has become 700 for, let's say, Policy Bazaar, and similar for Paytm. They're still way away from the IPO prices.
See, when they got listed, there was a absolute scarcity of new digital businesses. It was a time when Nasdaq and all those big tech companies were catching the fancy of many investors, and a lot of merchant bankers took advantage of that particular investor mood, and these companies got listed at unreasonable valuations. And then we saw what happened after that. There was a great deal of disappointment. Also, I think it took a while for the promoters of these companies to understand what investor expectations are. Till that point, they were listed, they were in conversation with the private equity investors, and they have different metrics to value the companies. But when you get listed, you're going to be compared based on solid profits, if not now, 3 years down the line. And that message clearly went to the promoters that, look, we are not interested in the number of clicks or number of users or how many people access your platform. We are interested in your top line revenue, EBITDA margins, and earnings per share. Okay, you may not have any of these financials just now, but can you demonstrate to us that 3 years, 5 years down the line, you will have a decent profitability? And that message has been well received by these companies, and all their strategies and all their communication is focused on when they can break even and when they can start getting a decent return on investment. And the street has liked that particular message which is coming from the promoters. And there you can now actually, kind of create a spreadsheet, and it's easier said than done, and project that 3 years, 4 years down the line, Paytm or a Nykaa or a PB Fintech or a Zomato can be solidly profitable. I mean, you just do the numbers. If they grow at 20% top line minimum for the next 3 to 5 years or so, and their expenses grow at a 10% top line, and you do the projection, the numbers will be fabulous. And these businesses they're not capital intensive. So, they'll generate huge amounts of cash flow as well. And they will always be valued at very high premium multiples because of the moat which they have created. So when you look at a longer term picture, 3 years, 5 years, 10 years down the line, then these are great stories. I think it's just that the real risk is that somebody may disrupt them, or they may get acquired by a old economy company, So those risks are there. But then, as investors, we are prepared to take those risks if we find even 1 or 2 of these companies turn out to be a 50 bagger or 70 bagger 10 years down the line. I think when I look back at my portfolio, the best returns have come when, you bet on such a company over a 10-year period and goes up by 40, 50 times, and that's how you get the outperformance.
I wanted to get in your thoughts as to how you're looking at the overall consumption theme, and what do you believe, you've made of the kind of volume growth slowdown that we've seen across the board. Is this a concern?
See, there are always going to be cycles within the consumption theme as well. And it's not an even pattern. There'll be some segments which will do exceptionally well while others are struggling. And that is true for the business, that has been so for the past many decades or so. The trick is to find the right segments, the right businesses which can deliver consistent growth, where there is great potential for them to increase their revenues as well. So and it's a very diverse kind of investment theme to play. But from what I understood from these quarterly numbers, automobiles have done well. That's a consumption theme. Real estate, although the actual profits are lower, but the bookings remain strong. Their average realizations are moving up. I think hospitals did exceptionally well, as did hospitality, that is hotel companies. And if you look at travel and tourism, that also has done very well. What has not done well, perhaps, is retail. including companies like Titan, and they're having a soft quarter also, which is perfectly justified. You cannot keep on growing at ferocious growth rates. Sometimes base effect and minor cycles are going to come into play. And by and large, I think FMCG is getting into a recovery zone where lower raw material prices are benefiting their margins. So it's not that you can paint all the companies engaged in the consumption space with a single brush. There are nuances, and one needs to account for that. But some engines within the consumption space are continuing to do well, and investors should focus over there, like auto, real estate, hospitality, aviation. I think they're all doing pretty fine.
Okay, actually, yesterday we had a conversation, stocks on the editor's radar, and Nikunj was talking about Tech Mahindra, how perhaps it's a special situation stock within the IT space. The general consensus is a bit negative on this one. Just curious about your thoughts then, Dipan. After having read into the numbers, pitching it against its peers within the IT space, what's the outlook on Tech Mahindra?
No, we'd like to, hold any investment or advise on Tech Mahindra. The results were extremely disappointing, to say the least. And while the stock price may move up for all tech companies, but large cap tech, I'm a bit cautious. I don't know when this whole thing will turn around also. And even if the entire IT industry spending does pick up, we're getting more and more focused on specialist mid-cap niche IT companies. Clearly, they have created their space within the industry. They are domain experts, and more, I think Fortune 500 companies are going to such mid-sized domain expert companies where they have the comfort of pricing, where they have the comfort of delivery, and they know that the best foot forward will be put for their projects. So I think the way forward from an investor's perspective is to look for good quality mid-cap IT companies which have a solid niche, which have a solid competitive edge. And those are the companies which will continue to grow at that 15-20% type of top line growth and give you a nice compounding return over the next 3 to 5 years or so. Without getting into, the names, we all know the top performers who have done exceptionally well for the last 3 to 5 years in the mid cap space. I think investors can place their bet on them.